Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a senior manager here at Schwab, and this is trading covered calls and short puts. And for some traders, the concept of getting called out can be kind of a scary thing. But for others, though, they may actually seek exactly that outcome using covered calls as an exit strategy for stocks they no longer want to own. Guys, that's what we're going to be talking about today. Selling a call at a time when we're already considering selling the stock. Could it be possible that we're getting paid a little extra to dump some shares that we don't need anyway? That's going to be an interesting discussion. I'm going to be talking through the pros and the cons of that sort of approach. Before we can get to that, though, let me first of all say hello to everybody out there on YouTube. Hello there, Life in the Fast Lane, David, John, Scott, Greg, Will, Robert, Bush 8531, Tony, A. Hiskell, everybody else. Thanks for joining us week after week. We really do appreciate your attendance and your contributions to these discussions. If you're here for the very first time, I want to welcome you as well. And if you're watching on the YouTube archive after the fact, enjoy the presentation. Be aware that you're invited to join us in a live discussion. This is a Monday webcast series, and it kicks off promptly at 2 Eastern Time. But we really would love to have you here in the live stream audience. I also want to let you know that my very good friend Scott Thompson is going to be hanging out in the chat. Scott and I have worked together now for decades, but Scott's going to be assisting with any questions that I can't get to just during the natural flow of the presentation. Thanks for having my back there, Scott. And I'd also like to issue an invitation to anyone, whether you're in the live stream audience or you're watching on the archive. If you're not following me on X, please do that. You can find me there on X at Cameron May CS. But X is the best place to connect with your favorite presenters in between the live streams. So love to have you there as a follower. But let's get right into this. And the first thing that we certainly need to do is to consider the risks associated with trading and investing. Risks are real, so this is important information. Options carry a high level of risk and are not suitable for all investors. The information here is for general informational purposes only and should not be considered an individualized recommendation or endorsement of any particular security, chart pattern, investment strategy. Schwab does not recommend the use of technical analysis as a sole means of investment research. All investing involves risks, including the loss of principal, and any investment decision you make in your self-directed account is solely your responsibility. So let's set the agenda for the day. A few items on the agenda. Number one, I do want to take a quick peek at previous covered calls and short puts that we've sold in previous webcasts, see how they're coming along. So we're going to follow up on some example trades that we've already placed. Then we're going to take a quick peek at the markets and see why for some traders, they may have this strategy of employing a covered call as an exit for shares of stock they were already considering selling, why they might be thinking about doing that in market conditions such as the ones that we're experiencing today. And then we're going to look at an example of doing this. So we're going to talk through an example position that I have loaded up in our paper money portfolio, and we're going to sell a covered call on it and try to use it as an exit. See if we can squeeze a little bit of income juice. Talk about the pros and cons of doing that, and we'll place a trade as we do it so that we even know how to push the buttons to get the thing running. So that's going to be what we're doing. Let's go right to the Thinkorswim desktop software platform here. Let me quickly, as we get into this, there is a question that just came in. Let me read it quickly. Okay, yeah, Eva, I'm going to leave that. I might be able to circle back to Scott with that one. Well, maybe Scott can address it, or I might be able to circle back to it. It doesn't dovetail very nicely with what I wanted to discuss today, so I might just sort of pause that one for later, but it's a good question. Anyway, so let's look at our positions here. We have Citigroup is a covered call position. We bought 100 shares and then sold a $77.50 call for the 21st of February. We actually did that 2 weeks ago, I believe. Let me click on the quantity here. If you click on the quantity, it tells you when the trade was placed. So we can see this was actually 3 weeks ago. So there are 25 days left in that covered call that we sold. That means add 3 weeks to that. When we sold this, there were 46 days left till expiration. And let's see what's going on with this. When we buy shares, we'd like for the stock to go up, but when we sell a covered call, typically the trader might prefer for the shares to remain below that strike. In this case, remain below 77.50. Citigroup is not below 77.50. It's up there at 80 and change. Here's what it looks like on a chart. So we entered our trade right back here on the 6th. You can see pretty rapidly prices started to rise. Is that a bad thing? Not necessarily, unless the trader really hopes that they don't lose. I don't like to use that phrase in talking about covered calls. Unless the trader was concerned about having to sell their shares, this is not, this might be a fine outcome. But with covered calls, we should always be prepared for the potential eventuality that we have to sell the shares. So in this case, bought the shares here, sold a call right up there at 77.5. So what we're doing when we sell that $77.5 call, we know that if it advances beyond that, the potential for additional capital appreciation is really going to someone else at that point. That's a trade-off for the premium that's collected. So what that means is that at the time of the trade, we have a limited amount that we can make for the duration of the trade. I want to do some quick math here. With Citigroup, we bought it at 73.05. It's worth 80.25. So if we didn't have a covered call, we just sold the shares, well, we'd be up about $7.20. But we do have the obligation to sell at 77.5. So let's just assume for just a moment the other trader decided to exercise their right. They assign this contract, and we're required to sell our shares at 77.5. Well, 77.5, when we bought it for 73.05, is still, by my quick math, $4.45 of profit on the stock. And if the other trader assigns their shares or assigns their contract at that point, whether it's at expiration or before, the premium collected on that contract becomes a realized gain. So that would be $4.45 that we could make on the stock, plus $1.03 that would be realized on the option. And that would be $5.48. Did I recap all that correctly? $5.48 of max gain. Let me just jot that down just quickly. Just as a quick note. Theoretical max gain on this trade, $5.48. So whether that happens today or it happens 25 days from now, that's the most that this trade can make as it's currently constructed. Well, what if we decided to get out of this right now? Getting out of this would mean buying or selling the shares at current levels and buying the contract back at current levels. So let's see what that would do. Well, if we sold the shares right now, $7.20-ish profit realized, assuming we get filled right around where it is right now. So $7.20 made on the stock, but we'd also have to close out this contract to close out the entire covered call position. Well, we sold the contract for $103, we'd have to pay at current prices about $3.45. So that would actually be a loss of $2.42-ish. So let's do some quick math here. If we made, let's get out our calculator, if we made $7.20 by selling our stock position, but we had a realized loss on the option of $2.42, we'd be realizing about $4.78 in profit on the trade net. The best we can do theoretically is $5.48. So right now we're within about 64-ish cents. I just did the math very quickly. I'm probably wrong. I am wrong. Anyway, 74 cents. Anyway, we're awfully close to the most we could make. So what do we think we ought to do? We could hang in there, see if we get assigned. If we get assigned, that would result in our maximum theoretical gain. Take some commissions out of there, and we've maximized this trade. Well, or if to have that happen, we may need to wait all the way till expiration. So it might take us another 25 days to make another 74 cents or whatever the math is. I should just do the math just to make sure. 548 minus 478 means that we have about 70 cents. That's why you do the math. About 70 cents left in this. If we wait another 25 days, that's the best this trade can do as currently constructed. Now, could we do other things? Could the trader say, you know what, maybe I want to hold on to my shares. Let's just take our lumps on the short call, just buy that back. And then if the stock continues to rise, well, now I don't even have a call in the way. That's a possibility. But if it falls, now you have a realized loss on the option, and the stock is starting to give back its profits and could even fall down into loss territory. So In this case, I think what I'm going to do is just close this one up. We actually made more than we've made about 80% of the maximum return of this trade in about half the time, a little bit less than half. So let's do this. Let's right click on the symbol for Citigroup. We're going to create a closing order to sell the whole covered call position. There we go. This is going to sell the shares that we already own and buy back the contract that we sold in just one order ticket. And right now it looks like we might be able to get a credit as much as 76.87. Bought the shares for about 73, sold the contract for about $1. So we paid about $2 to get $72. About $72 to get into this trade. If we're able to get out of it for 76.80-ish or and change, something like that, that's where our $4.80 of profit is coming in. Let's back off on this a little bit. Let's dial this down. Let's say we're willing to get out for a few pennies less. Mike says, hey, 80% of that maximum theoretical gain is good. I'd even take 65% at a pinch. Yeah, for each trader, they might have their own approach to managing the back end of these trades. But this is also a good reason for why maybe make it a habit to revisit this webcast series so that we can talk through the pros and the cons of doing these sorts of things on the back end of the trade. All right, let's nudge this down a little bit again. A few pennies less. Let's click confirm and send. So we're putting in an order to sell out of this covered call. We're going to try to pull out a total credit between selling the stock and buying the option back of about $7,682. Add in or subtract from that the commission to close out the put contract or the call contract. And let's send this order off. It is a limit order. We'll see if we can get filled. Let's go to the monitor tab. We'll let that work. 76.82 is what we're requesting. 76.86, 76.85 is what it's trading for. I feel pretty good about the likelihood of a fill there. We'll see if the markets are cooperative for a moment. But while we're doing that, we also need to note we do have an order in place to close this trade out should it fall. We have a stop order in place on this. So if we're closing out of this, we don't need that stop order anymore. So we had this order in place to get us out if the shares happened to go down. It didn't. Shares went rocketing up. So let's close out this order. Let's right click on that and just cancel that order. So we canceled if we happen to fall down below $67. So there's our Citigroup trade. Okay, there we are. Got out for 76.83 net. If you want to see how we did on the trade, well, we just take the trade price of the stock, which I believe was 73. I'd have to go off memory at this point. Anyway, we're out of that trade with a little bit less than $5 of profit. We only had the potential to make a little bit more than $5 of profit, so that's a good trade if we're defining that as getting most of the planned gain. Next up, we have NVIDIA. Mike, you like this class? Very good. NVIDIA is just a short put. When we sell a put, in this case, we sold the 21st of February, 110 put. That's a bullish strategy where we'd like the stock to stay above 110. Well, the stock is above 110. It's actually at about 118, which sounds nice. But let's look at what the chart is actually doing. Has anybody been following what's been happening with the tech stocks today? Getting crushed from some news from China. Apparently a very inexpensive AI product just came out of China and has undercut some of the enthusiasm in that tech sector. We'll see if that continues. But let's move over to NVIDIA. Boom. Look at that drop. This is a bullish trade. We would prefer to stay above our support here. We entered this trade right back here. The stock was behaving just as we might have hoped, going up and up and up. Our short put was losing value. And then we have this big gap down. That kind of is an intimidating move. But notice it actually hasn't gotten down to our strike yet. Still out of the money put. We do have a break even down here. We sold the 110 put for, I think, $1.12. That makes the break even on this trade down here at 108.88. Rams DeepSeek, yeah, exactly right. Yep, that was the name of the AI product. It's as relatively new to me as it is to you guys, so I'll have to do more reading about it over the coming days. But in any case, for some traders, they see a move like this and they might say, you know what, this is getting ugly. I'm getting out of here. Now, for others, though, they'll say, well, but the point of this trade is just for the stock to be above 110. It is above 110. It's coming down, but they may just hold on and see if the stock can just catch a little bit of a breather. If it starts to climb again, this is still actually in maximum theoretical gain territory. We only have one contract on this. I'm going to let this continue to work. It may be a mistake. We're going to talk about it next week. So there are pros and cons. If we decide to pull the plug on this trade, that would stem the bleeding. It would stop the bleeding. And that is assuming that we're able to get out. But we'd have to pay about 4 times as much to get out of this trade as when we first got into it. So that would be a realized loss of about a triple. Or we can hang in, and as long as we catch some support here, pretty soon, if its stock starts to rise again, actually, we're just in fine position for this to still just expire worthless. Now, even out of the money short contracts can be assigned, so we have to be aware of that as well. But that one, I'm going to let it work. Let's leave something in here to talk about in the coming weeks. But I want to go look at what's going on with the markets. Those are our 2 existing positions. Let's go see what's going on with the markets. There's the drop that's led by a lot of those tech stocks that are falling. The S&P is down about 2%. But it has been a fabulous run for the bulls, extending now for years. And let's put ourselves in the shoes of a trader out there. Let's say we're a trader and we're looking at the S&P 500 and we got this big gap down, and sometimes a big gap down, here's a smaller gap down, but it can lead to a larger run down. And so maybe the trader's thinking, you know what, maybe I'll go just sort of harvest some profits from my portfolio. Maybe take this as an opportunity to take some heat out of this portfolio. And let's assume that our trader has a stock like, let's say, Walmart. So here's Walmart. It's been running up and up and up and up and up and up. It's hitting 52-week highs. But let's say our trader bought back here, maybe just 9 months ago, 8 or 9 months ago, this was a $60 stock. So here in our paper money portfolio, let's say here's our trader with 100 shares. They bought it at $60 per share. And they're thinking, if I'm going to take some heat out of my portfolio, maybe I'll unload something that's nice and profitable for me. And maybe it possibly even serves the purposes of the diversification of the portfolio. Maybe they're moving out of, as we look at our sectors, maybe they're moving from consumer staples to some other sector that they have an interest in. Could be a number of motivations. For whatever reason, if a trader is ready to sell a stock, well, they can just sell it. That's okay. Let's do some comparative math here. Let's say we have choice A. In exiting a stock, choice A is just a plain old sell the stock. And right now, Walmart's trading at about 96.82. So let's say, in this example, we could just sell for 96.82. Or choice B is going to be this approach that I wanted to talk about today, which is where some traders will use a covered call as an exit strategy on a stock that they were prepared to sell anyway. So let me just throw this out there. Has anybody else experimented with this, maybe in your paper money account? Using a covered call as an exit strategy on a stock that you are prepared to let go? Because one of the facts of selling covered calls is that there's the possibility that you may have to, let's put that in air quotes, have to sell the shares. Well, maybe I want to sell the shares. Well, now it's not really a concern that the contract might get assigned. It might actually be the desire of the trader to get assigned. So choice B, let me separate that by a line so it's nice and definitively different. Let's look at choice B, sell a covered call on that stock. So here's going to be our example trade for the day. So here's our Walmart, 100 shares. Now this is really If we're selling calls and we want this to be an entirely covered position, we need to have at least 100 shares per contract that we're entering into. But let's go to our trade tab, and let's say the trader is okay with waiting some time. I'm going to stick with the 21st of February. That's the next monthly expiration cycle. It will tend to have greater liquidity than the weeklies. Not that there's anything inherently wrong with the weeklies. They just tend to have a little bit more favorable pricing at the monthly expirations. So let's go to the 21st of February. And I'm going to do something that's going to be a little bit counterintuitive to some traders. I'm going to I think I'm going to eyeball this one first. Let's look at maybe selling, as our example. We're going to sell the 21st of February $90 call. Now, if we do this, think about what we're getting ourselves into here. If I own some shares, those shares right now are worth about $97. Look at this, they were worth $96.82. Those shares are strengthening right now. So I might be able to get a little bit more, more for this call than I was thinking. Anyway, if the shares are worth 97, but I'm entering into a call contract where I'm selling a call for 90 bucks, what am I actually getting myself into? Well, this is where the trader is agreeing to sell the shares for less than they're worth. That just to me, that sounded crazy when I first heard it. Why would I enter into a contract where I'm agreeing to sell shares for less than they're worth? Well, because somebody is paying me to do it. So how much might we get paid right now? Right now, it looks like trading somewhere between $7.85, $7.95. Might be able to do this for $7.90. So basically what we're doing is we're giving someone the right to buy our shares at a $7 discount from where the shares are trading right now. I'm rounding just a couple of pennies. That's a pretty close statement. Giving someone the right to buy a $97 stock for $90 is a $7 discount. If we were just giving that to them as out of the goodness of our hearts, it would be taking $7 out of our wallets. But we're not doing that. We're actually getting paid $7.90 to get into that contract. You notice there's a little bit extra that's left over. This is actually what the trader is targeting here. It's just that 90 cents. It doesn't sound like a lot, but a 90-cent potential on a $90-ish stock is about 1%. And in 25 days, that's not a terrible little addition to just exiting. So let's talk about how this might work. And I might actually need to move the strike here just a little bit. But I think we're going to stick with this one. Yeah, I might wind up doing a different strike just because markets move. I have it all mapped out how I want to discuss it. And then as we're talking through the webcast, things change. That's okay. But let's talk through why a trader might do this from here. Let's go to our chart and let's compare a couple of potential scenarios. Could just sell the shares for $97 and the trade's over. But here's where the trader is just trying to squeeze out, maybe it's just 1 more percent, which may not sound like a lot, but if they're trying to do that on multiple trades, if those trades work out, they don't always work out. We want to talk about how the trades can not work out optimally. But it's the trader who's trying to add a little bit of extra to their exit. Let's do a comparison. Choice A, if we sold the stock at 96 or 90, I'm going to ramp it up to $97 because it's moving around enough. And that's close enough that for points of comparison, for educational discussion, close enough if you can forgive me for rounding off a penny. And can we get a little bit more for this call now? Let's go back to our trade tab. Yeah, we might be able to get $7.95 here. All right. Let's compare how this trade is very likely to work out. And I can say very, very likely, quite confidently, because the probabilities are in the favor of this trade. Now, it doesn't mean it always works. But let's talk through, if we do this, what can happen on or before February 21st. Okay? What if the stock continues to strengthen? Well, you might feel like, crud, I should have kept the shares. Sorry, if we sold the shares, that's sort of crying over spilled milk, right? But if the stock continues to rise, Let me draw in a line here to represent that potential outcome. The stock continues to rise up here, and someone has the right to buy shares from us for $90, which is way down here. Let's draw in a line down here at 90 bucks. That's close enough. If someone has the right to buy shares from 90 bucks and they're way up here at 98 or 99 or 100, are they going to do it? Yeah, at expiration, it's a near certainty. It's not exactly certain because there can be some rare exceptions to that, but at expiration, all in-the-money contracts are assigned unless explicit instructions have been left to not do that. So in that case, we wind up selling the shares at 90 bucks. Well, crud. Could have sold them before for $97, so that's a $7 setback. But we also got $7.95 from selling this call contract. So if we sell the shares for 90 and we add in the now realized gain of $7.95 from the call contract, the net between those two is as though we sold the shares for $97.95. Again, 95 cents doesn't sound like a lot, but that's almost exactly 1% improvement on just selling the shares in the first place. And so for some traders, they see this as potentially a better way to exit the stock position. Now, better is always sort of realized in hindsight. Did it turn out to be better or did it not? Because we have to talk through that. What is the likelihood of this outcome? What do we think the chances are that the stock goes up or that at least doesn't go down so far that it reverses this outcome? Even if the stock came down, let's say it came down to these levels that it had through a good bulk of the end of December and into January. What if we're down here at $91 at expiration? Well, if somebody has the right to buy our shares for $90 and they're still worth $91, are they going to do it? Yeah, they're going to do it. But again, with very rare exceptions. They buy the shares from us, even though they've fallen in value. They're still worth more than 90 bucks. At that point, we've sold the shares for 90. We keep the $7.95, and that is still like we sold the shares for a net of $97.95. It's an improvement over even having sold the shares while they were still way up here. So what is the likelihood? I wanted to talk about the likelihood of this outcome. Maximum, theoretical, maximum outcome is selling the shares for 90 bucks plus $7.95 realized gain on the option is $97.95. I'm not going to call it max gain because the gain just depends on how much you ultimately bought the shares for. So I'm going to call this just our maximum outcome. All right? What's the likelihood of that outcome? Well, we can look at the option chain and get a good feel for that. So I'm going to introduce, for some of you, this is going to be a new column. For some, it's going to be very familiar. Instead of using delta, which I sometimes use, I'm going to pop up here, and I'm going to go to theoretical outcomes. Let's customize our data set. And I'm going to type in probability of being in the money. Let's add that to our column delta, theta, and vega. Let's click OK. What is the probability that the stock is still above $90 as we hit expiration? The contract is assigned, and we wind up selling the shares for 90 bucks and keeping that, whatever we collect on that premium. About 83%. So we're looking at about an 83% likelihood that we've improved the exit on the stock by about 1%. That, to some traders, is quite attractive. So that's one of the pros of this sort of a strategy, is that it most of the time will result in a more profitable exit. I have to say most, not all the time. Where it's the other 17%. We got to talk about that. Now, another thing the strategy does is it lowers, even though we're still holding the shares, it's lowered net the break even of the trade. Let's suppose that we just roll the clock back, and while we're mulling over the $97, so we just own the shares of stock. Shares are worth 97 bucks. We're trying to decide whether we're going to sell them or not. We haven't even thought about covered calls yet. As long as we keep thinking about selling and we haven't sold, the stock is still moving around. And if it starts to go a penny below 97 bucks, well, now we can only sell it for less. If it keeps falling, the break-even point from when we first started thinking about selling becomes an important benchmark. If the stock continues to fall, well, now we're losing that opportunity to sell at that $97. That's sort of the break-even point, if you think about it that way. Obviously, for the purchase price of the shares, theoretically, we bought this all the way down at 60. I'm just talking about, what about from the moment we start considering exiting? So let's talk about the break-even point when we sell this call. Well, when that premium is collected, as long as the stock doesn't fall by more than that amount, it's lowered that day one break-even point by $7.95. So in this case, what would that be? Well, $7.95 below $97 is going to be all the way down at $89.05. Had to do that math in my head. Call me out if I get that math wrong. But let me just let me illustrate that. Let me remove this drawing. Let me remove this drawing. And let's draw in another line right down here at $89.05. Right about there. That's close as I'm going to get it. Why is this our break even? Well, let's say the stock, we enter into the contract, we get paid $7.95, and then the stock falls. And it drops all the way down to $89.05, and we hit expiration. So we'll draw in a line to represent that. It goes right down there by expiration. Well, if someone has the right to buy shares from us for $90 and they're only worth $89.05, are they going to do it? Probably not. They can if they wanted to, but they're probably not. They're going to leave us with the shares. Cameron, keep the shares. They're not worth my $90. They're only worth $89.05. And so I think, okay, well, I still have my shares, except I've surrendered some significant value. They were worth 97 bucks. So while I was waiting for this contract to run its course, it dropped $7.95 in value. I've surrendered $7.95 in my stock value, but I also collected $7.95 on the option. That's a wash. So that's the break even. So we really have lowered, we provided sort of some comfort here, a comfort zone. As long as we are above $89.05, we're still doing essentially just as well as having exited at 97 bucks. So all of that is great. So we have a couple of potential pros to doing this strategy. Number one, it is a high probability that we're increasing the profitability of the exit. That's great. Number two, we've lowered the break-even point on the trade while we're sort of thinking it through. Now, those are the pros. What are the cons? Well, number one is we have to retain stock ownership for better or for worse. If the stock collapses in value, we're still the owners. The other party in the contract can always just walk away and say, Cameron, keep those shares. I don't want them anymore. So we might have to absorb any losses if it falls further than $89.05. So retention of ownership when we otherwise were prepared to sell, that's one thing. We may not get assigned, which is kind of a funny way to put it. When getting into covered calls, commonly a trader is thinking, oh no, what if I get assigned? In this case, it's, oh no, what if I don't get assigned? That might leave me with the premium collected, but then I also have to deal with whatever the market value of the stock is at that point. And if it has fallen below $89.05, net at that point, well, we would have been doing better to just get out at 97 without getting into the covered call at all. So this is, it's not a flawless strategy. It should only be implemented if a trader is comfortable with the pros and the cons. And there's one other thing that we need to talk about, and that is it still does have limited upside, just like any other covered call. From the moment we place this trade, the most we can make is this maximum theoretical outcome. It's really pursuing just a little bit more income with a high probability of success, but that still carries some risk. So let's do this trade. I wanted to talk about this. This is going to give us right now roughly an 83% likelihood that we're just no longer going to be owners of these shares of Walmart come 25 days from now, and we'll have an exit that would be mathematically better than exiting right now for 97 bucks. Let's see, how much can we get for this $90 contract? Right now, it's still right around $8, maybe a little bit less. Let's see if we can get that $7.95 for this. I'm going to click on this on the bid price. And as long as we do this in the same account where the existing shares are held, it already automatically becomes a covered call. We don't have to like designate it as a covered call or anything like that. We just need to make sure that we're only selling one contract for every 100 shares that we own. And we have the right strike. We have the intended expiration. It's a call. Let's see if we can, well, we're probably not going to get 790 anymore, which means price is probably fading a little bit on the stock. But let's see if we can get 790. And let's click confirm and send. Going to sell these calls, trying for 790. The max profit, max loss, be aware that this is going to be treated as though we don't own the shares, like this infinite maximum loss. That'd be true if we didn't own the shares. We do. They're in this this account. But we do need to be aware that the commission applies here. But let's send this order off. See if we can collect that 790. So one thing I wanted to talk about while there it is. So we sold that, okay, at 790. So we were within a nickel of the whole discussion that we just had. But one thing that I want to talk about is where might a trader draw that line? How much is enough? You know, for some, they might look at this and say 90 cents, that's actually just a shade under 1%. For 25 days, that might be adequate for the trader. But another column that might be helpful to the trader is something known as the extrinsic column. Now, how many of you are familiar with extrinsic value? The extrinsic value is really just the time value of the contract. When we were selling this contract, it was a $7 discount from current price. That's the intrinsic value of the contract. The other 90 cents is the extrinsic or the time value of the contract, which in this sort of an approach represents the potential icing on the cake for the trader. So that would be the 90 cents. Wouldn't it be just nice if we just had a column that just showed us the 90 cents? Yeah, let's come up here to our column headings again. Let's customize our column sets. And I'm going to remove the probability column, or maybe we'll just leave that on there. But I'm going to add extrinsic. If you didn't know that was a potential column, it is. Let's add that and click OK. And so what this is showing us is just net how much extrinsic value the contract has. And for some traders, this is very handy because what they can then do is just eyeball, is this at least 10% of the current price of the stock? Is it at least a 1% premium? Did I say 10%? Is it at least 1% of the current price of the stock? If it is, then that contract is offering at least a potential for 1% quote unquote improvement on exiting the shares right now. So right now you look at it, it's 88 cents versus just selling at 97. Might not be enough. Let's pop down here. $1 of extrinsic value is a little bit more than 1% of the current value of the stock. So that can be a very quick visual reference point. If a trader is using 1% as their minimum, they might need more than 1%. They might settle for less than 1%. But it's nice to have that calculation already performed for the trader. Okay, but guys, we've actually, with that, this will be interesting to see how this plays out. From here, what does the trader want? Well, if they're really looking to sell the shares, they just prefer for the stock to be above $90, which it has a high probability of doing We just need to get out here to February 21st and allow these contracts to be assigned, or they might be assigned before, which would just mean that we had our improved exit faster than expected. All right, but everybody, there's our discussion. I wanted to talk through today, quickly revisit our existing positions. We did that, and we set a sort of a conceptual foundation for why a trader might consider exiting some stock positions right now and how they might do that in a different way than just going and pushing the sell button. Maybe they go and sell a call. That call, when sold deeply in the money, the way that I illustrated today, leads to a higher probability of an improvement on the trade, but there are significant cons that come along with this. We can't dismiss the fact that now we've got to hold on to the shares, and come what may, we see what happens before expiration. It could be that the shares fall in value. So there's a number of considerations here. If this is your first exposure to this strategy, maybe try it out on a stock position in paper money. See how it works. See if you can talk through the logic of the trade. How much is the most I can make? How much is the most I can lose? What are the probabilities of both of those outcomes? What would the stock need to do for both of those outcomes? And that's when we really start to make informed decisions about these kinds of strategies. All right, Greg, Ocean Life, my pleasure. Everybody, thanks for giving me your time today. If you enjoyed this is what we do on Mondays. I'd love to have you as a regular viewer, either in the live stream audience or if you're just watching on the archive, that's terrific too. But it's time for me to wrap this one up. But as I do, let me first of all say, be aware that you have other resources outside of these webcasts. Number one is make sure that you're following your favorite coaches on X. That's the best place to connect with us in between the live streams. You can follow me there at Cameron May CS, and it doesn't cost anything to follow us on X, but that's where we can go if we see something happening in the markets. We can post it there. When you reply to one of my posts, I try to reply right back to you. It's a great place for interaction with your favorite instructors. It isn't really otherwise available outside of the webcasts. But number two is just to make sure that you're subscribed to the Thinkorswim, the Trader Talks channel. So Trader Talks Schwab Coaching Webcast is our YouTube channel. Just click on the subscribe button right down below the video window right now. And it doesn't cost anything, literally only takes a second. But Trader Talks is where we host our previous webcasts. You can find the playlist for our previous webcasts right here. You can join our live streams right there. So do that if you haven't done it already. But it's time for me to let you go. Thank you to everybody that's already clicked the like button. With about 150 people watching right now, we've got 68 that have already given the thumbs up. That's always appreciated. Thanks for doing that. Scott, thanks for helping out in the chats. Definitely appreciate your assistance today. Everybody, I will see you again next Monday for another discussion in this series. I have other webcast series every day of the week, so I'd love to see you in those as well. I'll also look for you on X, but whenever I see you again, until that moment arrives, I want to wish you the very best of luck. Happy trading. Bye-bye.